If you're a frequent viewer of the channel, you know I usually recommend index funds and ETFs in my videos. But I know some of you like to pick some individual stocks, or at least mix a few of your favorites in. But how do you know if the price of a stock is undervalued, fairly priced, or maybe a total ripoff? One of the most common tools investors use is the PE ratio. I hear a lot of people talk about it all the time when valuing a company, but honestly, half the stuff they say makes no sense. The truth is, the PE ratio is one of the most misunderstood metrics out there. People misuse it all the time, and it can lead to some pretty bad investing decisions. So in this video, I'm going to break down what the PE ratio actually tells you, how to use it, and just as importantly, when to ignore it. By the end, you'll know exactly how to avoid the common mistakes that trip so many investors up. Oh, and stick around because I'm going to break down some interesting moves Warren Buffett has made with Apple and how they relate to the PE ratio. First, let's go over a few basic definitions. Earnings per share, or EPS, is simply a company's net income minus any preferred dividends, all divided by the number of outstanding shares. For example, let's say a company's net income minus preferred dividends is $10 billion, and it has 2 billion shares outstanding. That would give it an EPS of $5. If the stock is trading at $100 per share, you can find the price to earnings ratio, or PE ratio, by dividing the stock price by the EPS. In this case, 100 divided by $5 gives us a PE of 20. In simple terms, the stock is trading at 20 times its earnings. Sometimes investors refer to this as a stock is trading at a 20 multiple, meaning investors are willing to pay $20 for every $1 of earnings. Another way to think about this is it gives us what's called the earnings yield of a company. The earnings yield is simply the inverse of the PE ratio. For example, if you have a PE ratio of 20 for a stock, its earnings yield is simply 1 divided by 20, or 5%. Now, you don't actually need to do all these calculations yourself. You can look them up pretty much any place, like a place like Yahoo Finance. It'll give you the EPS for any company and its PE ratio. Here we see the EPS for Apple is 6.31 as of March 2025, and its PE ratio is about 38. Now, notice those numbers are followed by TTM, which means the data is based on the trailing 12 months. Essentially, it's looking at the past earnings. There are also forward-looking PEs, but I'll get to those in a bit. First, let's go over how to use the PE ratio correctly. So imagine we have two companies in the same industry. Let's say two fast food chains. Just for fun, I'll call one of them Planet Pizza and the other Burger Blast. You're trying to figure out which one might be the better investment. You see that Planet Pizza has a stock price of only $60 and an EPS of $2, giving it a PE ratio of 30. Meanwhile, Burger Blast has a stock price of $120 and an EPS of $6 a share, which gives it a PE ratio of 20. At first glance, Burger Blast might seem like it's more expensive because the stock price is double that of Planet Pizza. But the stock price alone doesn't tell you anything about value. Since Planet Pizza's PE ratio is 30, while Burger Blast is only 20, that means that investors are paying more per dollar of earnings for Planet Pizza. So even though Burger Blast's stock price is double that of Planet Pizza, its lower PE ratio suggests it could be a better value, while Planet Pizza might actually be overpriced. Let me take a quick moment to say I'd really appreciate it if you hit the like button, maybe leave some comments below afterwards. It really does help the algorithm and it supports the channel. So thank you for that. Okay, now in general, a high PE ratio could signal that a stock price is high relative to its earnings and may be overvalued. On the flip side, a low PE ratio could suggest that a stock price is low relative to its earnings. However, the key thing to remember is that you should only use the PE ratio to compare companies within the same sector. Valuations and business models can vary widely across different sectors of the economy. For instance, companies in the energy sector, like oil and gas, have a lower PE ratio due to their capital-intensive nature of the business. Compare that with a tech company, like a cloud service provider, which tends to have a higher PE ratio due to a rapid growth and relatively lower capital requirements. Even within the same sector, things can vary. For example, you wouldn't compare the PE ratio of a renewable energy company, like a solar firm, to that of a traditional oil and gas company. PE ratios work best when comparing companies with similar business models, growth prospects, and industry conditions. But the PE ratio isn't all that useful on its own, and it shouldn't be the only metric guiding your investment decisions. There could be very good reasons why a stock deserves to trade at a low PE ratio. Think of it this way. You go to the grocery store to buy some hamburger. You see some on sale, but it's discounted because it's about to expire. The color has changed a little bit, it's kind of brownish, and it just doesn't seem that fresh. You could either pay more for better quality or save some money on something inferior. It's kind of the same with stocks. A company might have a lower PE ratio simply because it's losing market share, isn't growing, or has inferior management, while another company might have a higher PE ratio because investors expect it to grow and increase profits. As Warren Buffett famously said, "Price is what you pay, value is what you get." A cheap stock isn't always a good deal, just like an expensive one isn't necessarily overpriced. You have to look deeper and know the difference. Speaking of Buffett, you can also look at how the PE ratio of a single company has changed over time. That can be helpful. Take a look at this chart. It shows how the PE of Apple has changed from 2010 to early 2025. As you can see, from 2010 to around 2020, the PE bounced around mostly between 10 and 16. During the past 4 years, it's been significantly higher, and now is around 38 in early 2025. Now, let's take a look at what Warren Buffett did with his investments in Apple. He started buying Apple in the first quarter of 2016, when the share price was around $30, and the PE ratio was about 11. He kept buying throughout 2016 and continued adding to his position into the third quarter all the way up to 2018. By this time, the stock price had risen to around $50 a share. Over the next few years, he bought and sold smaller amounts, but early in 2023, he owned over 950 million shares. As you can see, in 2024, the PE ratio had climbed well above its historical average. It just so happens that Buffett started selling large portions of his position at the end of 2023 and continued trimming in each quarter of 2024, selling around 650 million shares at prices between $180 and $225, right as the PE ratio was peaking. Now, I don't claim to know exactly the reasoning for his selling, but it's worth noting that he accumulated shares of a quality company when the PE ratio was low and trimmed back when the PE ratio was much higher. Maybe he now sees better value elsewhere. So here's a quick rundown of the biggest limitations and common mistakes with PE ratios. First, be careful with forward-looking PE ratios. They're based on analysts' estimates and opinions, which can be overly optimistic in good times and too pessimistic in downturns. Plus, they change constantly with market conditions. 2. PE ratios don't work well for startups or unprofitable companies. If the company has little to no earnings, the PE ratio becomes meaningless. It's much more reliable for mature companies with a solid track record. 3. Watch out for cyclical stocks. Industries like energy and manufacturing go through earnings booms and busts. A cheap PE today might just mean earnings are at a peak and about ready to drop. 4. Debt matters a lot. Two companies can have the same PE, but if one is buried in debt and the other has a really strong balance sheet, the comparison isn't fair. Plus, companies with heavy debt loads are much more vulnerable to interest rate hikes. 5. Companies can manipulate their earnings. They can use accounting tricks to make their earnings look better than they really are, and this can distort the PE ratio. 6. One of the biggest limitations is the growth rates really matter for a company. A low PE might seem like a bargain, but if the earnings aren't growing, it could be a value trap. On the flip side, a high PE might be totally justified for a fast-growing company. Using a PE ratio without considering growth is just plain silly. That's where the PEG ratio comes in. It compares the stock's PE to its growth rate to give a more complete picture. I'll be covering that in the upcoming video, so stay tuned for that. The bottom line is the PE ratio is just one piece of a puzzle and shouldn't be viewed in a vacuum. Always consider the bigger picture before making any investment decisions. Thank you for watching.